Hello everyone, my name is Nabila Natassya binti Zulsli. Today I will talk about MSc Plantation Berhad and Negeri Sembilan Oil Palm Berhad. Now in this video I will talk about the three types of accounting that have been implemented in the both of company. First of all is accounting policies, accounting basis and accounting estimate. Okay, now we will move to the first type of accounting, which is accounting policies. The definition of accounting policies is specific principle and procedure that have been implemented in the of the company in their financial statement. The example of accounting policies is accounting policies can be used to manipulate the earning. For example, company can be used the method of average cost, FIFO, which is first in, first out, or last in, first out, LIFO method of accounting. Okay, now we will move to the accounting policy that have been implemented in the both of company. In both of company, MSc Plantation Berhad, Negeri Sembilan Oil Palm Berhad, they use the inventory at the lower of cost and net realizable value, and the financial statement in the both of company have been prepared on the historical cost basis except as disclosed in the accounting policies below. Now we will move to the second type of accounting in the both of company, which is accounting basis. In example, accounting basis is cash basis and accrual basis. The cash basis of accounting record revenue when cash is received and expenses when they are paid in cash, while the accrual method record income item when they are earned and record deduction when expenses are incurred regardless of the follow of cash. So they have two example. This is very clear for you to understand what is accounting basis. First example of MSc Plantation Berhad, in the accounting basis, revenue from sale of plantation produce is recognized of net of discount and taxes at the point in time when control of the good has transferred to the customer, while Negeri Sembilan, the revenue from the sale of goods is measured at the fair value of the consideration received or receivable, net of return and allowance, trade discount and volume rebates. For the second example, which is the interest income, for the MSc Plantation Berhad, interest income is recognized by applying effective interest rate to the gross carrying amount, except for credit impaired financial asset where the effective interest rate is applied to the amortized cost, while for the Negeri Sembilan Oil Palm Berhad, the financial statement is measured at a amortized cost and interest bearing financial asset classified as AFS. Okay, now we will move to the last of accounting, which is accounting estimate. For your info, accounting estimate is a technique to measure those items in accounting that have no accurate way of quantification and are therefore estimate on the basis of judgment and knowledge derived from past experience. For example, is trade receivable, depreciation method, and goodwills. For example of accounting estimate, the book of company is apply the same thing which is we take look on the loan and receivable, which is loan and receivable were non-derivative financial asset with fixed or determinable payment that were not quoted in an active market. Loan and receivable was subsequently measured and amortized cost using effective interest method. This MSc Plantation Berhad also apply in Negeri Sembilan Oil Palm Berhad. It is the same of method that have been used. Okay, now we will look to the lease payment. For MSC Plantation Berhad, the aggregate benefit of incentive provided by the lessor is recognized as a reduction of rental expenses over the lease term on a straight line basis, while the operating basis or operating lease payment for the Negeri Sembilan Oil Palm Berhad are recognized as an operating expenses in the statement of profit or loss on a straight line basis over the lease term. That's all for the types of accounting in the.
Hello and Assalamualaikum everyone. My name is Nurqamarina. An entity shall apply this standard in preparing and presenting general purpose of financial statement in accordance with Malaysian Financial Reporting Standard. Other than that, by referring to paragraph 35, 36, 27 and 28 in page 503, the measurement of MFRS 101 have mentioned about going concern and accrual basis of accounting. What it is mean about going concern? Okay, going concern mean when preparing a financial statement, a management shall make an assessment of an entity's ability to continue. And for accrual basis of accounting, an entity shall prepare its financial statement except for cash flow information. Next is recognition of MFRS 101 by referring to paragraph 15, page 955. Financial statement shall present fairly the financial position, financial performance, and the cash flow of an entity. Fair presentation requires a faithful representation of the effect of transaction and others event. And lastly, for disclosure, by referring to paragraph 117 and page 521, an entity shall disclose in summary all the significant accounting policies, which consist the measurement of the accounting basis used in preparing the financial statement and the other policies used in preparing financial statement. Okay, for Negeri Sembilan Oil Palm Berhad, the financial statement of the group and the company have been prepared under the historical cost basis, and the same with MHC Plantation Berhad that is show the company have been prepared under the historical cost basis. Other than that, both companies' financial statement are presented in Ringgit Malaysia. Next, these two companies also shows that these financial statement are for the groups and companies report. And lastly, these two companies consolidate financial statement financial year ended is both on the same date, which is 31st December 2018.
Assalamualaikum warahmatullahi wabarakatuh. My name is Aisyah Amani binti Zamri. My ID is PDA 1805070 and from DIA 6D. Next, I will talk about MFRS 127 separate financial statement. The scope for MFRS 127 should be applied in accounting for investment in subsidiaries, joint ventures, and associates when an entity elects or is required by local regulation to present separate financial statement. This standard does not mandate which entities produce separate financial statements. It applies when an entity prepares separate financial statements that comply with Malaysian Financial Reporting Standard. For measurement, if a parent is required to measure its investment in a subsidiary at fair value through profit or loss in accordance with MFRS 9, it shall also account for its investment in a subsidiary in the same way in its separate financial statements. At the date of initial application, an investment entity that previously measured its investment in a subsidiary at fair value through other comprehensive income should continue to measure that investment at fair value. The cumulative amount of any fair value adjustment previously recognized in other comprehensive income should be transferred to retained earnings at the beginning of the annual period immediately preceding the date of initial application. At the date of initial application, an investment entity shall not take adjustment to the previous accounting for the interest in the subsidiary that is had previously elected to measure at fair value through profit or loss in accordance with MFRS 9. Next, the recognition when an entity becomes an investment entity, which shall account for an investment in a subsidiary at fair value through profit or loss in accordance with MFRS 9. The difference between the previous carrying amount of the subsidiary and its fair value at the date of the change of status of the investor should be recognized as a gain or loss in profit or loss. The cumulative amount of any gain or loss previously recognized in other comprehensive income in respect of those subsidiaries should be treated as if the investment entity had disposed of those subsidiaries at the date of change in status. Dividends from a subsidiary, a joint venture, or an associate are recognized in the separate financial statement of an entity when the entity rights to receive the dividend is established. The dividend is recognized in profit or loss unless the entity elect to use the equity method, in which case the dividend is recognized as a reduction from the carrying amount of the investment. Disclosure required in separate financial statements that are prepared for a parent that is permitted not to prepare consolidated financial statement. The fact that financial statements are separate financial statements that the exemption from consolidation has been used. The name and the country of incorporation or resident of the entity whose consolidated financial statement that comply with IFRS have been produced for public use and the address where those consolidated financial statements are obtainable. A list of significant investment in subsidiaries, joint ventures, and associates, including the name of those investees, the principal place of business, and country of incorporation if different. Of those investors, its proportion of the ownership interest and its proportion of the voting rights if different, held in those investees. From the two companies that we choose, which is MHC Plantation and Negeri Sembilan Oil Palm Berhad, the business combination are accounted for using the acquisition method. The cost of an acquisition is measured as the aggregate of the consideration transfer, which is measured at acquisition date fair value, and the amount of any non-controlling interest in the acquired. For each business combination, at fair value or at the proportionate share are the acquired identifiable net assets. Acquisition-related costs are expensed as incurred and included in administrative expenses. In the separate financial statement of the company, investment in subsidiaries are accounted for at cost less impairment losses. On disposal of such investment, the difference between net disposal proceeds and their carrying amount is included in profit or loss. In MHC Plantation, investment properties are recognized when either they have been disposed of or when the investment property is permanently withdrawn from use and no future economic benefits is expected from its disposal. Any gain or loss on the retirement or disposal of an investment property is recognized in profit or loss in the year of retirement of disposal.
My name is Nur Fatihah binti Ralid. My ID number is PDA 1805067. I am from class 6D. To share with you about MFRS 1J7, which is MFRS 1J7 about provision, contingent liabilities and contingent assets. Firstly, we must know about the definition of contingent liability. Contingent liability is defined as the potential duty resulting the past event and the present of which only by by the occurrence and non-occurrence. While contingent asset is defined as the potential asset that result from the past event and whose present is verified by only by the occurrence and non-occurrence. While the provision means can be differentiated from other liabilities such as trade payable and accrual due to uncertainty about the timing or amount of the future settlement expenditure is permitted. About the scope of the MFRS 137. First, the scope is standard. This standard does not apply to financial instruments, including guarantee that are within the scope of FRS 139 financial instrument recognition and measurement. Executory contract which is contract under which neither party has performed any of its obligation or both parties are partially performed their obligation to an equal extent, where this standard does not apply to executory contract unless there are onerous. Standard neither prohibit nor require capitalization of the cost recognized when provision is made, while the standard is applied to provision for restructuring, where restructuring meets the definition of documented operating and addition requirement. The recognition of the MFRS 137, a provision recognized when a. The entity has present obligation, legal or constructive, as a result of the past event. B. It is probable that an outflow of resources embodying economic benefit will be required to settle the obligation. C. A reliable estimate can be made of the amount of the obligation. Financial statements deal with the financial position of an entity at the end of its reporting period and not its possible position in the future. Therefore, no provision is recognized for costs that need to be incurred to operate in the future. The only liability recognized in an entity balance sheet are those that arise at the data. Therefore, no provision is recognized for costs that need to be incurred to operate in the future. The only liability recognized is an entity balance sheet or those that exist at the balance sheet data. Contingent liability may develop in a way initially expected. Therefore, they are assessed continually to determine whether an outflow of resources embodying economic benefit has become probable. If it becomes probable that an outflow of future economic benefit will be required for an item previously dealt with as a contingent liability, a provision is recognized in the financial statement of the period which the change in probability occur, except in the extremely rare circumstance where no reliable estimate can be made. Contingent assets are assessed continually to ensure the development are appropriately reflected in the financial statement. If it has become virtually certain that an inflow of economic benefit will be arise, the asset and the related income are recognized in the financial statement of the period in which the change occur. If an inflow of economic benefit has become probably, an entity disclose the contingent asset. This MFRS is the best estimate, where the amount recognized as a provision should be the best estimate of the expenditure required to settle the present obligation at the balance sheet data. Next, the entity should disclose first is the carrying amount at the beginning and the end of the period. Second, additional provision made in the period, including the increasing to existing provision. Third is the amount used during the period. Fourth, the unused amount reversed during the period. Fifth, increasing during the period in the discounted amount arising from the passage of the rules and the effect of any change in discounting rate. Compare two company that we have choose in our assignment. Okay, this how the company apply the MFRS 137 in their company. For first, the MHC plantation, the financial year, there were no material changes to or from account or arrangement other than those reported in the statement of change in equity. For the Negeri Sembilan oil plantation, during the financial year, there were no material changes to or from reserve or provision other than those reported in the financial statement. Plantation provision are recognized when the group has a current obligation as a result of the past occurrence, where it is possible that an outflow of economic capital will be needed to resolve the obligation, and the sum of the obligation can be accurately calculated. Provisions are checked and updated at each reporting date to reflect current best estimate. If an outflow economic resources is no longer likely to be required to settle the obligation, the provision will be reversed. If the effect of the time value of money is material, provisions are discounted using an exacting pre-tax tax that reflect that the risks specific to the liability were appropriate. When the discounting is used, provision increase due to the passage of time is recognized as a finance cost. So for Negeri Sembilan oil plantation, the provision are recognized where the group and the organization have a present obligation as a result of a past occurrence, where it is possible that an outflow of capital and doing economic benefit will be required to satisfy the obligation, and a reasonable calculation of the value of the obligation can be made. If the group and the company plan to repay any of all the benefit under an insurance policy, the reimbursement is treated as a separate asset, but only if the reimbursement is reasonably assured. The cost relating to a policy is reflected in the income or loss statement, not net of any reimbursement. When the impact of the time of reimbursement is significant, the regulation are calculated using a current pre-tax tax that represent the liability specific risk. Where applicable, when discounting is used, the increase in provision is known as financial cost due to the passage of time. So it's same also with the MHC plantation. So next, okay, as we can see, the comparison, which is where the MHC is transfer the substantially, while the and also Negeri Sembilan oil plantation do not substantially transferred.